Hey, this is Bert Salazar. I hope that you and your family are doing well. Lately, I've been getting a few questions regarding the taxation of life insurance contracts. And although it could be a complicated subject because I do a lot of tax planning for clients and small businesses as well, I'm going to try to clarify it for you in a way that you can apply it to your own personal situation. Now, life insurance has always been one of the most versatile products that you can own when it comes to the arsenal of financial services products that are available in the marketplace. And life insurance has certain benefits and features that no other contract in the United States does have under the IRS code. So there was a point in time many years ago where you could buy a life insurance policy, get a fairly low benefit, and then you can overfund that contract and put a lot of money in it and have the money grow tax deferred, and then you would be able to pull the money out tax free. So one of the challenges that the IRS noticed along the way was that every time someone put money into a life insurance contract, and I'm talking about people and companies that were overfunding these contracts by hundreds and hundreds of thousands of dollars on an annual basis, and there was no reporting whatsoever. There weren't any taxes. They didn't have to file taxes and put it in their tax returns or anything along those lines. That for many years the IRS had been looking at that scenario and figure out what they could do, because at the end of the day, they wanted to limit eventually the contributions you could make to a life insurance contract, because they wanted to let you play, but they also wanted to tell you how far you could play in the life insurance game. So something interesting happened in 1988. And in 1998, the government passed what is known as Tamra, which is the Taxes or Tax and Miscellaneous Revenue Act of 1988. And that actually changed the rules of engagement to the taxation of life insurance contracts. It actually created for the first time in history a MEC, which is a modified endowment contract, which I'll explain in the next couple of minutes. And it also created the 7-pay premium. So up until 1988, you could make all kinds of contributions to a life insurance policy, have the money grow on a tax-deferred basis, pull it out on a tax-free basis, and avoid having to pay ordinary income taxes and capital gains taxes. I believe back in the 70s and 80s, capital gains taxes were actually fairly high. They were between 20% and as high as 39%. So if you were an investor or you were someone that had a lot of wealth and had a lot of money, then using life insurance contracts was a good thing for you because of the tax avoidance that you could legally obtain. Now, after the Tax and Miscellaneous Revenue Act of 1988, TAMRA, once again, the rules of engagement changed. So all of a sudden now, you just couldn't put as much money as you wanted to in an insurance contract. Now it was going to be actuarially based. It was going to be based on the IRS code. The IRS would dictate what would be the most amount of money that you could place into a life insurance contract. And it would primarily based on your age and the face amount that you would purchase. So the higher the face amount, the more flexibility the IRS would give you to put money into the contract. And this is very important to understand, especially from a taxation and from a business perspective. So for instance, after 1988, if you purchase a life insurance policy, the insurance company would run a quote for you based on your age and your health status, where you're a smoker, non-smoker, and then ultimately how much death benefit that you want to purchase. And an insurance company would say to you, look, the minimum premium that you can put into this life insurance contract would be $5,000 a year, and the maximum premium would be $25,000 a year. So between $5,000 a year and $25,000 a year, you had all the flexibility in the world, as long as you contributed the minimum of $5,000, and then from that point forward, you could determine how much to contribute in addition to the $5,000 on any given year. So that gave the American public and people that wanted to invest, flexibility. Now, not as much as they had before prior to 1988, but it still provides some flexibility. The problem was that if you made too much of a contribution, and let's say that the maximum that you could have contributed was 25,000, and you contributed $26,000, then that entire contract and for the rest of it of the contract's life, that would have become a MEC, a modified endowment contract, which actually changed the taxation rules. Number one, if you wanted to take money out of that contract, you no longer had the ability to take money out up to the cost basis, meaning up to the contributions, the after-tax contributions that you made. And then you didn't have the ability to, once you hit the equity portion that had not paid any taxes in the contract, to be able to switch to loans and continue to take money out without having to pay federal income taxes. Yeah, you would have had to pay a small loan fee to the insurance company because they were lending you that money and putting a collateral assignment on your contract. But that interest would be minimal in comparison to the tax liability that you would have on that money in the future anyways. So it made all the sense in the world. But once a contract becomes a MEC, you no longer have the ability to do that. So it becomes a LIFO-only contract, last in, first out. So if you're going to start taking money out of a modified endowment contract, the first monies that you would pull out would be the growth of that money, just like in a traditional non-qualified annuity would be. And most important, then once you withdrew all of that interest, then you could evade principal and take principal out. So that, obviously reduced the flexibility for the investor and the owner of the contract. And it also reduced the viability of using that contract as a supplemental retirement plan because it was no longer beneficial from a taxable standpoint. The second thing that a MEC would do, or the second thing that a MEC actually did when it came into effect in 1988, is that if you wanted to take money out prior to age 59 and a half, when you really didn't need to take that money out, but you just wanted to take that money out, then in a traditional life insurance contract that was not a MEC, you could take the money out prior to age 59 and a half and have no liabilities. You wouldn't pay a premature distribution, that 10% rule that you would find in traditional 401ks and IRAs and so forth. But the minute that a life insurance contract becomes a MEC, now if you take money out prior to age 59 and a half, then you're going to have to not only pay taxes on the distribution because you no longer have the ability to use loans as a form of distribution, but most important, you would also have to pay a 10% premature distribution penalty. Now, I do have a number of clients that have MEC contracts, and they have it just for a simple reason. They only want to use it as a death benefit only contract. So they have no intentions of ever taking money out of their cash values in the contract because they want to leave it as a legacy for family members or whatever it may be, or even a buy-sell agreement. So the only time that they're going to exercise that contract, it would be at the time of death. At the time of death, even if it is a MEC or a modified endowment contract, then obviously the death benefit, including the cash value that has been building inside of the contract, would actually go tax-free to your beneficiaries without any tax ramifications whatsoever. So if you have a MEC and you just want to leave it there as a death benefit only, then you would be okay. There are no taxes or liabilities along those lines. But if you want to use the contract as a supplemental retirement plan, then you're going to have some challenges because you're no longer going to be able to borrow the money once you hit the end of your cost basis and the beginning of the growth of that contract. And now you're not going to have any other choice but to take the money out and pay taxes from day one. So that's not something that you want as far as the taxation of a life insurance contract. One of the great features that life insurance provides is flexibility. And if you use a life insurance contract as a supplemental retirement plan, and I'm going to do another video as to how to actually fund a life insurance and or a 7702 contract, then obviously you're going to have a tremendous capability of putting a lot of money in on it and have that money grow tax deferred and then be able to pull it out tax free through withdrawal to cost basis and then switching to loans at time of distribution or once you hit that section of the distribution portion of that contract. So even though the 1988 Tamra kind of reduced the flexibility that you had before because you no longer had the ability to put as much money as you wanted to, it still provides, even up until this day, the ability for you to be able to fund a properly structured 7702 contract to the level that you really want to if you need a specific type of funding at any point in time. Another major feature that you have in a 7702 contract is that it gives you the ability to catch up. If we go back to my example, where the insurance company dictates what the minimum contribution or premium should be to the contract, in this case it was $5,000, and then the IRS determines that 7-pay premium or the maximum that you can contribute on any given year, in this case was $25,000. What would happen if in year one you only contributed $5,000? Then in year two, you contributed, let's say, $15,000. But then in year three, you had a really good year in the business and you had a lot of revenues that came in, and you would want to max fund your life insurance contract at that point in time. Well, here's what you could do with a life insurance contract that you could not do with a traditional IRA or 401k or any other type of pension. You could actually, since in the first year you only put $5,000 and you could have put $25,000, you can take those $20,000 that you did not fund for that given year in the first year and add it on to the third year. Then you go to the second year in which you contributed $15,000 out of the potential $25,000. So you can take that $10,000 arbitrage and add it on to the third year. So now you're up to $30,000. And then for the third year, you can also contribute the maximum of $25,000. So in year three, you can actually catch up for year one, year two, and make a lump sum contribution of $55,000 into year three without jeopardizing the viability and the tax benefits of the contract, because the contract would now be a modified endowment contract. And finally, when they created under the 1988 Tamra Act, they created the modified endowment contract rules. They created something known as the 7-pay premium. And basically what it does is it lets the purchaser of the contract, it lets them know how much money they can fund into the contract every year for the first 7 years of the contract to make certain that the contract would not become a modified endowment contract or MEC. And the calculation for the 7-pay premium is the amount of premium that an insurance company, based on the rating that you obtained and based on the death benefit that you purchased, the amount of premium that is necessary in order to fund that contract and have it totally paid up after 7 years of premium payment. So in other words, for the first 7 years, whatever premium, whatever the IRS allows you to contribute to that contract, it means that at the end of the 7th year, if you put no more premiums, then that contract should be totally paid up for life, and you would not have to fund it with an additional dollar from a business perspective. So, I'm hoping that you're able, now, obviously there's more complications depending on what it is that you want to do with a life insurance contract. But if you want to learn a little bit more and you want to reach out to me, please feel free to do so. You can call me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember, my goal for you and your family is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thanks very much for giving me a few minutes of your time, and I'll talk to you soon. Take care.